Lots of new data out this week, all pointing to potentially good news from the Fed and sending stocks rallying. Inflation was flat in October and retail sales were cooling. All positive indicators for the Fed, but investors are still holding their breath for a rate decision next month. Are we in the clear for a soft landing? Well, for more on this, Esther George, former Federal Reserve Bank of Kansas City CEO and President, is here. Thank you for joining us this morning. So obviously, hopes here for a soft landing. History would tell us odds not in the favor. I believe it's 1 out of 11 attempts in the last 60 years the Fed has managed to stick a soft landing here. What are your expectations?
Well, it's something we all hope for, don't we? Which is that everything operates smoothly. But the truth is, the Federal Reserve itself has acknowledged they've not yet landed. And by landing, I mean that they would have achieved their 2% inflation target. So I think everything points to smooth sailing today. But of course, they are a ways away from having achieved their target. So I think more to come for sure.
To that point, Esther, we did hear from the Fed chair last week saying that he's not quite sure that current monetary policy is restrictive enough to bring inflation back down to that 2% target. I've heard you say that you'd be happy to wait a little longer if you were still on the committee. I'm curious what questions you still have.
So when I think about the economy right now, we have a lot of rate hikes that are still in the pipeline. And I think we have yet to see those fully work their way through. And remember, at the same time, the economy is adjusting to the imbalances that we've seen coming out of the pandemic. So the combination of those things suggests to me that as long as the data is coming in a fashion that doesn't show the economy reaccelerating, that the Federal Reserve does have time to pause here and to look carefully to confirm the data that they're seeing and to make sure that they are in fact progressing toward that 2% target. So when the chairman says not yet sure that they're sufficiently restrictive, I think that is an indicator that more time is needed for them to gain confidence that they're headed in the right direction.
And Esther, I mean, even as we look at what we've seen with weekly jobless claims at a 3-month high, continuing jobless claims rising to the highest in almost 2 years, sort of these incremental indicators here. But what about some of these factors that are outside of the Fed's foray here? What are you watching in that space?
So the Federal Reserve, of course, has a dual mandate. It certainly is keeping its eye on inflation right now. But ensuring that it does so with an eye on the labor markets is also important to them. And of course, the labor market has been quite strong. We have seen people coming back in. The participation rate has improved over time. We're watching the jobless claims begin to inch up, but still very low right now. And so even as the unemployment rate has ticked up, it is still at a historically low rate. And I think watching this jobs data is going to be a very critical signal around how the economy is moving. It will be a lagging indicator for sure, but this has been an aspect of the economy during this post-pandemic period that has been particularly tight, has drawn people back in, which is good. But it is one of the signals that generally you watch as demand cools in an economy is how is that translating to employment.
Esther, really quickly here, looking to DC, I mean, it does appear as though a shutdown has been averted, but we did see Moody's downgrade the outlook for U.S. credit on the back of the uncertainty. When you think about the sheer amount of debt spending that's happening right now, what's more concerning to you, that or the gridlock that's happening in DC in terms of the impact that could have in the U.S. in the economy?
So I think you have to think of both of those as quite concerning. Obviously, good news that it appears there will not be a shutdown. Shutdowns are costly at many levels to our economy. And so that's good news. Being able to govern and to address these issues is going to be very important over the long term, though, because even as government sources like the Congressional Budget Office have already confirmed for some time, we are on an unsustainable path with the level of debt. And that must be addressed if generations to come are going to enjoy a standard of living in this country that we want. And so, even though in the short term we have averted a real, I think, jarring outcome by not having this government shut down, it is really critical, I think, that these issues of fiscal discipline be addressed in the near term.
Esther George, former Federal Reserve Bank of Kansas City CEO and president. It's great to get your perspective today. Appreciate the time.